Hi, good morning, everybody. Good morning, everybody.
Good morning, Mr. Sushant. How are you?
Good morning.
Yeah.
Good morning, friends. I hope the slide is visible to everybody.
Yeah,
Yes, yes.
Yes, sir.
Finally, with the minor hiccups of the technology. So, interesting topic for the day. It will be a glance through an overview of valuation. Although it's an overview, but it covers quite structural frameworks of valuation today. We will go through the value principle today. Then the purposes briefly. We would discuss the valuation standards in greater detail. We would understand the premise and basis of value. Then a little bit on the report side, and then on the documentation side. So kind of you'll get a glance through of whole overall valuation process today as we discuss. And thank you for the uh, RVO for having us here today morning and being Sunday. Actually, IBBI is Sorry, friends, some internet issue. So I'm going through with the mobile connectivity. Hope it works. Yeah. So I was just saying that the regulator has come up with guidelines on use of caveats, limitations, and disclaimers in your report. So as we proceed and as you become, super qualified valuers in times to come, you will know and understand that what is the importance of these caveats and limitations and disclaimers, which is very important from a risk perspective and liability perspective, and to understand and know how to limit your liabilities and cover your risk is very important from a personal perspective, and also from an end user perspective. What all things that they have to see and go through, and what they should focus upon is also very important. So coming back to the basic of valuation, friends, I personally believe that we all are valuers, whether or not we realize, recognize personally. Why? Because we do a lot of sale purchases in daily needs. From a pencil, paper, pen to a chocolate to a grocery to a vegetable. Because we try to shop everything with a perspective. The price that you pay for every piece of product or service, you try to evaluate individually. Each one of you will have different perception about any product or any service. So that differentiates between you all, that the value perception is different for each one of us for the same price. So for example, let's suppose there is this water bottle, and the price that each one of you will perceive will be differently. If I say this comes for 100 rupees, somebody would never like to have it. Somebody will, okay, fine. Somebody will say, oh, I need it badly, give it to me, right? So it all depends upon how do you perceive it. And if I say, this bottle is unpriced, and you try to price it, so I am sure again each one of you will give a different price points for this bottle. Again, it all depends upon the value perception. So friends, we know value very closely, we perceive value very closely. It is just that we don't differentiate between price and value at times. So price is mostly at the times negotiated between the two parties when it comes to a transaction or a contract, while the value is more intangible. It is perceived value of the same product. So suppose if I want to get a ball pen from a market, if I am in need of a special blue gel-based ball pen, I won't mind paying 20 bucks or 40 bucks for the same. But if somebody would want to get a just pen, so he might look at cheaper options, right? Why would I spend 40 rupees for a pen if I could get a pen for 5 rupees or 10 rupees? So it is all derived from what you need and how you need in terms of your daily needs. So starting with the basics of valuation. So we were discussing just now about what we confer as value, how we define value as, right? And we have always heard this saying, and I love this line, because values are like fingerprints. Nobody's are same, but they leave them all over everything you do. It's a very relevant perspective from a value standpoint. Everybody of us have heard this, and it stands good every time. You value a company from somebody else's perspective who has given you this mandate, and you arrive at a value, let's suppose 100 crores. But an investor which is coming in and trying to buy the same underlying company might have a different value proposition because of various structural changes that he thoughts. His standards of value would be different. His requirement would be different. He would be looking value as a different orientation than what you look from inside. So, well, it is said, value lies in the eye of the beholder. This is what I was mentioning too. Price is generally, friends, what we pay and value is a more intangible perceived value, tangible that you receive at the end. The PPT is visible or not to everybody, please?
No, it is not visible.
No, sir, it's not visible.
No, we are not shared the screen.
Now,
Yes,
Yeah,
sir.
it is coming.
okay, okay. So I'll go back a little bit on this presentation. This is just this is the structure of our pointers today that we have to cover. We were discussing about the famous sayings, about the people that we keep hearing. Let me do the full screen now. Yeah. So coming to the basics of value, friends, we were discussing. So value is something which is monetary worth of future benefits that one is going to receive from the underlying asset. Price is always negotiated between the two parties, and to the seller who has built this asset is relatable to the direct resources that have been consumed and for which the seller is seeking a particular price. So, on overall basis, conceptually, framework, these are the parameters. The asset will have a value if it fulfills, few characteristics. It must be of utility to you, otherwise you will never go out and shell out any single money. It must be scarce for you. That is why you're going ahead and trying to buy it out and get a perceived value out of it. And obviously, it must be transferable because if seller is not able to sell, the buyer will not get the ownership rights and the usability factor of that underlying asset. So some basics around value and value perceptions to start with. I'm not sure if anybody of you have done or in the past any kind of valuations uh, yet, but always remember this slide, friends. Whenever a client approaches you, this stand goods for anybody and everybody. Every time a client is approaching a professional or super expert like one of us, reason being, he has to define that why he requires evaluation today. What is his need? Because every other challenge will start from there on. Why? Is it a regulation driven? Is it a transactional driven? Is it a particular, order of the court, or it is a reporting valuation? What it is actually driving the need, which is of utmost importance to us to understand. Under what regulation, under what section, that we need to go through the valuation report. Then, who is doing means till now there are various experts who are able to do this valuation. Like there are different kind of asset experts, land and building, plant and machinery, security and finance, in Companies Act, and in otherwise for some cases of income tax and RBI regulations, it still talks about the category one merchant banker. So you have to be very very sure, careful about what who is entitled to do this valuation exercise. And the third most critical thing is the timeline. For the same asset at a different timeline, the valuation can be way different. We are all living in a live example, friends. If you have valued any company in Jan, Feb, or maybe early March, right? And if you are valuing the same company today, there is a sea difference in overall orientation, market dynamics, statistics, and hence the derived opinion of value. So, friends, always remember these three critical pillars of valuation. that will always help you in clarifying a lot of things before even you proceed to the your entire scope of work. Okay, this is a beautiful slide because it talks about the requirements of valuation. It talks about why evaluation is required in India. We can spend the entire day discussing about each and detailed topic, but I wanted try to did in this overview of valuation that you should know and understand that these are huge spaces where your need would be generated by these parameters, and you would be doing the valuation for all these purposes, so to speak. So the market is really big, friends. It's not small, as we say, but it is all required. How far you can go and how what all you can do. So for the sake of easiness, I have divided that into three parts: transactional purposes, regulatory purposes, and accounting purposes. See, in accounting purposes, it is more of a reporting valuation requirement. When books are compiled and prepared and presented, then it is required whenever a company issues stock options to its employees. It requires a hit in its P&L that what is the fair value of those options. So you have to do the fair valuation for those options, applying various models. If it is an unlisted company, then again you have to do the valuation of fair market value of the stocks. Indian accounting standard fair valuations. There are huge list of accounting standards impacting various asset classes, instruments under which you need to state their fair valuation for the respective auditor to take it from you as a third party expert person and get it embedded in their balance sheet, because most of the balance sheet today are driven by the fair value determination and adoption, and they have to do this exercise year on year, every year. Now, friends, as far as purchase price allocations are concerned and impairments are concerned, it generally happens when a company takes over other company. So, for example, company A takes over company B, and the total fair value of the net assets of company B is, let's suppose, 60 rupees, right? But company A has paid 100 rupees for the same, which means even after doing the fair valuation of the entire assets and liabilities of the company B, the overall value comes to be 60. But company A has paid rupees 100, so it has paid rupees 40 extra. So this extra purchase price paid over and above the fair value of the net assets acquired. Earlier, friends, it used to call as directly as goodwill. But today, these purchase price have to be allocated amongst various identified intangibles in the company B. So there is a requirement that you need to identify reasons for which company A has paid company B such an additional price of 40 rupees. So friends, we go there and ask the company and check the company and see what kind of intangibles the company B has, whether it had got long-term contracts from the client, whether it got some networks, distribution network, whether it has got an IP on this software, whether it has got a great team, as a internal team, or it has got some great customers, something like that. So you identify those intangibles, you value those intangibles, and you come to a point where out of 40 rupees, let's suppose 20 rupees goes for one intangible, 10 rupees goes for another intangible. So now you're left with residual 10 rupees. So that residual 10 rupees goes to the goodwill part. And friends, the entire exercise of this allocation of excess purchase price into intangible is called purchase price allocations. And once you have done this exercise, so every year you will test the basis in the financial reporting methods, and that is called impairments. Gone are the days of rule based depreciation, because now and then every time you have to look at the life of the asset, actual useful life, and impair the assets accordingly. So again, a huge requirement. I mean, every year, March to September and October, you can see the number of thousands of Indian companies, lakhs of companies undergo all these fair value transformations, and hence, the requirement is quite large. Now, friends, coming to the transactional mode, in any case of mergers, acquisitions, you require a fair value opinion for the parties to understand the value that has to be derived from the transaction. In every fundraising activity, friends, either as a company you are going forward to raise the funds, or as a lender, if he is giving the money to a borrower, they would like to understand the value drivers of the underlying company to better understand the asset quality, better understand the overall, situation as in value, what and how the company derives value, and how it's gonna be profitable in the times to come. Obviously, in any case of business sale or purchase, it is again a very imperative equation to understand what value is being shared between the parties. At times, friends, people go for voluntary assessments of valuation, maybe because they are going through a growth trajectory. They wanted to know what my company is valued today and how can I enhance my value from today to tomorrow, right? If I'm standing today at 100 crores, then how can I plan to become a 300 crore company in 5 years, for example? So many companies do those also, and many companies would ask for valuation for their portfolio of brands if they have the brands in their portfolio, and they would like to see the brand valuation and assessments and positioning and the entire marketing around it year on year on a regularly basis. So again, these are very some critical point-to-point examples for you to understand. We know much about the regulatory side because whenever the money flows happen cross-border, either a company is sending money outside ODI or the company is coming to India FDI under RBI FEMA regulations. One has to give a fair valuation of that underlying company. As of date we speak, RBI talks about the Category 1 Merchant Bankers Report. But in times to come, friends, as we are seeing the convergence of all the acts, the valuation bill is coming in. So we are seeing that the convergence of the acts will happen very soon, and all these acts and regulation will converge to requirement for a registered valuer, which you all soon will become. Again, in income tax, there are specified sections where it asks about valuation to be done through certain specified methodology for specific purposes from a category 1 merchant banker. SEBI again deals with the companies which are all listed. So any acquisition, buyback, takeover, blah 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 thing will happen for the listed companies. So SEBI comes out with the rules that how you need to value those companies for such end usage purposes, for a investor protection purposes. Again, a huge requirement there. Companies Act, any movement, friends, in the capital of your company, it will ask for your expert opinion of value, whether it is initial capital, interim capital, or later on any capital adjustments. Every time you touch a capital account, you will be called for to express your expert opinion of value. When a company is listed, friends, so at times, under the listing agreements, you need to furnish certain details of your assets, or when you declare some corporate finance deals within your company, as per stock exchange requirement being listed in that stock exchange, you need to undergo certain valuations, which is again done by experts like one of you. Since 2016, friends, the insolvency and bankruptcy code has opened up a plethora of requirements for stressed assets and stressed companies, and the regulation has specified a lot of things, that how it has to be done, under what standards, under what methodologies, and stuff like that. And if you are appointed by a resolution professional, then what all you need to go through under those insolvent or under insolvency proceedings of those stressed assets. At times, friends, the courts also can ask for a specific valuation to be done or a review of valuation at the time of litigation in the court. Now, litigation could be of any kind of type or for any kind of asset. So these are very broad areas where your requirement can come from, and they are fairly large. I can tell you, if you start practicing valuation, they're fairly large, and people require a lot of expertise in similar domains. I mean, somebody who is doing Indian accounting standard fair valuations, he may not get time for doing anything else because that is in itself a plethora of accounting standards, and to comply with those is again a task. So the field is quite vast, friends. So somebody who is doing IBC would be only doing IBC, for example, and somebody doing SEBI work is only doing SEBI work. So rest assured, there is a great amount of scope of work for specialist professionals like us in India. Okay, as we were discussing, IBC. So I thought to give you a brief spec. I don't know whether you have gone through the class of IBC yet or not, but I will be touching upon very few critical aspects quickly to understand what the regulation says. So, friends, whenever a company is stressed or is in a qualified NPA, then or maybe if it is not able to pay the dues of any of its stakeholders, which means the bankers, the vendors, governments, or employees, right? So anybody of these guys can file an application in NCLT and ask for the resolution of payments. So whenever an NCLT accepts this application, it comes under the corporate insolvency regulation provisions of this code, CIRP 2016. So then when NCLT accepts the application, it appoints a insolvency professional to steer the entire framework of regulations, and he becomes the de facto board of directors of the company, and the erstwhile board of directors will become the suspended board of directors. So all the rights comes to the IP, but the old directors will have all the responsibilities at the same time. So this IP will appoint within certain designated time period of after his appointment by NCLT, he would appoint two registered valuers under each asset class of the company if there are all the three assets classes in the company, to determine liquidation value and fair value of the assets of the corporate debtor. Corporate debtor means the underlying company which is being inducted into the NCLT for these proceedings as on insolvency commencement date. So this ICD, friends, is what the day when company enters into the NCLT. So that date is very important because entire valuation exercise is frozen on that timeline. So whatever valuation that you do, whenever you are appointed, whenever you visit the site, you have to give the valuation as on insolvency commencement date only. And these are all the regulation points as it is. The fair value and liquidation value to be computed in accordance with the internationally accepted valuation standards after physical verification of the inventory and fixed assets of the corporate debtor. Now, friends, when this regulation began in 2016 and 17, a lot of IPs were interpreting that they only require valuation to be done of fixed assets and only stocks because the regulation says so. But as and when the IP started, learning from the practices and practical challenges, the awareness came to being that IP has to share the entire information memorandum on the assets all the assets of the company, from fixed assets to the cash, it needs to get valued from an expert like you, one of you. And for any asset for which the valuation has not been done, he cannot give the value by himself. He is not an expert. So slowly and steadily, people start realizing that although it is verbatimly written in the regulation, physical verification of the inventory and fixed asset, but the spirit of the law is that the entire valuation of all the assets of the company has to be done. And for that matter, different experts of asset classes of registered valuer needs to be appointed, and two valuers under each category. Now let's suppose, friends, the IP has appointed two valuers for the valuation, and they did their exercise. They concluded the valuation opinion, and what if the valuation opinion of these two valuers are way different? So regulation gives a solution. It says a resolution professional can appoint a third valuer if the estimates of the values of from the two valuers are significantly different. Now, here again, friends, the regulation does not talk about how much different. It talks about significantly different. Now, if you go back to certain case laws or practices, best practices, that what this significantly different qualifies logically also, the difference of opinion of value for the two experts for the same asset, for the same purpose, for the same timeline, with the same set of information being given by from client should not be significantly different, which means the difference should be only to the limitation of the expert opinion, professional judgment, right, on certain assets quality and not otherwise. So typically it should not go beyond 10 to 15% in general. That is what is the adopted principle in the market. But it is again debatable. So it depends upon how people perceive this. But at times when situation arises, when the difference is too much, then the RP might appoint a third valuer. And after the third valuation, wherever that third valuation is either on the A side or the B side, the average of the two will be taken as the final values. Friends, this value that you calculate, fair value and liquidation value, is very critical, not only for the IP, but for the liquidator also. So, for example, when the resolution of this company fails for some reason and the companies enter into the liquidation process after this, the then liquidator appointed would also see these valuation reports and seek guidance of value from these liquidation value. The committee of creditors formed, friends, to steer the entire resolution process requires this valuation. The investor which is coming from outside to take over the company also is at the helm of these values. Yeah. So this value is very critical, friends, from every standpoint, and our role as valuers are very critical in the entire process of insolvency proceedings. And this is how regulation has panned out the entire process. So as I was mentioning, on a typical balance sheet, if you see, you'll find some of these typical assets as is. There would be obviously generally in general land and building. There would be in general plant and machinery. There would be some kind of capital work in progress pertaining to those capital assets being not capitalized yet. There may or may not be certain intangibles on board. There can be a non-current investments. There will be a stocks of inventories. There could be receivables, debtors. There could be some short and long-term loans and advances, and some other current assets. So whenever you look at the balance sheet, you'll find these some kind of assets. And for an IP, all these assets need to be valued by an expert. And whenever experts value and give a value to the IP will take this cash flow, and as per the regulation, it will try to distribute to the stakeholders, claimants. That is the whole process. Okay. So as the regulation talks about internationally accepted valuation standards, friends, which is very important because as of now there are no standards when the regulation has framed. There are no particular standards there. So it said that if there are certain international accepted valuation standards which are applicable to all the three asset classes, those valuation standards can be adopted to discharge your valuation duties or assessment of value. So here we come to some kind of standards in the worldwide markets. Predominantly in India, people have adopted to International Valuation Standards Council London, which we're going to discuss now, because it's a global non-for-profit framework of standards adopted in more than 50 countries with regular updations, friends. And in fact, our institute is one of the institutional member of this organization, and it supports various businesses across the globe in all the asset classes, be it land and building, plant and machinery, or financial assets. And most of the people adopt IVSC from uh, headquartered in London for its various valuation principles. So any standard, friends, would generally boast of global framework of valuation providers. Then it will boast of reflect the global nature of businesses. It would guarantee certain kind of quality and define the international best practices, right? It will be recognized by leading valuation organizations. This standard particularly is an asset specific standard, so it gives a lot of importance to all the asset classes. A lot of data are there which are comparable cross border globally under this standard, and that is why IVS is being widely adopted in India to ensure the transparency and consistency in the evaluations. So, for example, if all of you would engage in a valuation assignment and you all are, you know, abiding by the IVS standards, so at least the structure of the report, the standards followed, more or less, the practices, methodologies used are harmonious. They are not entirely different, right? So the confidence by the end user is quite high when you do a structural valuation or you do a, phrase valuation, so to speak. Okay. IVS is, structured in these three parts, friends. The first part talks about the framework. The second is general standards, which are applicable to all the asset classes. And then there are asset-specific standards, friends. So, which is applicable for a very, very specific typical situation. Like for a specific intangible asset, if you need to refer, some rights in certain kind of properties, if you need to refer, right? Some kind of lease and other agreements. So for very, very specific requirements, they have identified and detailed in asset specific standards. Otherwise, general standards cover the entire blanket of framework of things which is required to be there for all the asset classes. If you go through the standards, it's a good thick book. Plus, don't be afraid because I have tried to give the gist of all the standards here only in this presentation. And if you remember this presentation by heart, you will never face any challenge either in practice or in your examinations. So let's proceed to framework, friends. The IVS framework talks about adherence or compliance with the standard. Like if somebody is adopting IVS standards, so it is complying with the entire framework of IVS. It applies to both assets and liabilities. it is applicable to the valuer who is signing off the reports under IVS standards. This standard talks about objectivity, being impartial, being transparent, and it also applies not only to you, but if you are using the work of any specialist and expert in your report, so it applies to them also. And if you are a valuer firm, friends, it applies to within your firm other individuals, practitioners also. And the best part which I like about IVS is that you cannot or may not able to implement all the valuation um standard requirements subject to a practical situation. So there could be a possibility of departures. So if there is any departures in applicability of these standards, then you must mention in the report. That is what it is required. So this covers a broad framework of things. So if you use IVS and adopt, you have to comply with the standards. It applies to assets and liabilities. It applies to you in person. It applies to your firm people and you're the experts that you use the knowledge of. Now, friends, jumping off to the main standards. In your examination point of view, you might be asked 104 talks about which kind of standards, right? So 104 is talks about scope of work, reporting, valuation approaches, or basis of value. So very simple way of remembering this, friends, is take the first letter of each of these standard and it becomes SIRBV. Sir, business valuer. You will never forget the sequence and the number. So whenever a question asks, you will quickly understand and trace the right answer. So these five generic standards cover almost all the scope of work in general applicable to all asset classes. The scope of work defines a lot of things in 101, as in what should be the scope and how do you go for it. Friends, this standard defines investigation. You might not have heard this before in your valuation uh, side because the responsibility of digesting the data from the client is also on our shoulders, right? So you just can't take the input given by the management as it is and write the report. Your report is not icing on the cake, but you have to deep dive in the cake itself. You need to reassess, you need to reconfirm, corroborate things, right? Apply certain tools and techniques, and then go ahead. So you need to investigate any data points. Then comes the reporting structure, friends, which is very important. And without basis and standards of value, nothing is could be compared in the two valuation reports that on what basis they are made. So this is of utmost importance and critical. And your favorite topic, friends, valuation approaches and methods. What all approaches and methodologies you should adopt and how you should do the valuation and stuff like that. So we will quickly go through these standards and understand their requirements and challenges. Friends, we all are professionals and we do an assignment with an expectation of a perceived value, right? So the perceived value comes from a scope of work. And so one needs to define your scope of work in-depth detail. So I get a lot of queries from people that how much we should charge for any scope of work, what should be our requisite fee, right? So friends, understand, fees is a direct output or derivation of your man hours, and your man hours are defined through your detailed scope of work. And how do you determine your detailed scope of work until and unless you know why your client has come to you, the purpose of valuation, and after understanding the purpose of valuation, you have to give him the checklist of documents of information, you know, as maximum as possible, and make him understand what all needs to be done in the subject assignment. Because if the client will not appreciate or understand your scope of work from A to Z, he will not be able to understand your man hours devoted. People comes to you, sir, please value my this company. I need this report by today evening. Is it possible? No. Friends, today's time is very critical. Every value derivation that you do requires deep dive into various facets of business, and you become part and parcel of those critical business function along with the client. So understand that your engagement and involvement will be quite deep, because you need to follow certain standards, you need to follow certain methodologies, you need to state certain things in the report. So for that, you need a lot of checklists from the client, a lot of deliberations, lot of iterations, and hence your man hours. So if you are so long, so big man hours are involved, so your fees would be accordingly fixed. So 101 talks about the scope of work, which says that you have to be very clear about the identity of valuer. Who would be the valuer required under what regulation, right? If they says it requires a IVBI registered valuer, then you are the person. You need to understand the client very clearly. You need to understand intended use of the report, the assets underlying which needs to be valued, under what currency, basic purpose of valuation, what standards of value it has to be required to complete my valuation. What is my valuation date? Is it 31st March? Is it 30th July? What date it is? What sources of information would I require and need to furnish in the report? Significant assumptions I need to make while doing the work of valuation, and hence if any limitation in my scope of work. This is very critical, friends, because whenever you read your valuation rules, so there is a list which talks about the minimum contents of the report. That must be a part of your study material. If you go through the rules, it says, I think from A to H, there are pointers which talks about the contents of the valuation report. So IVS standard also talks about the same, and both are not much different. Both are very much same. So if I jump off to 103 first, friends, it talks about the reporting. The report must convey the minimum of the following. And what is that? The scope of work performed. Now again, go back to 101. So point number 3 in entirety. All these 11 points become part of your report. 10 approaches adopted, and within those approaches, methods applied, and by what inputs you have applied those methods. What were your assumptions in executing the evaluation? You know, and how you concluded amongst all the approaches, how you concluded, and what is your data flow. So, friends, those 11 points plus these 6 points. So, as per standard, 17 points are very critical. And if you add all these 17 points, your report is ready. Now, it doesn't matter you start from here or you start from here. The important point is your report should not miss these things, and it must be loud and clear. And if you go to valuation rules, you will feel it is a kind of a mirror match between what standard says, what is globally adopted, and what the valuation rules also says. Because valuation rules is also derived from somewhere. So if you complete, friends, listing of 101 and 103, your valuation report is ready. Right? Now we come to 102. So a valuer is expected to do an appropriate investigation for the purpose of the valuation assignment. Now the limits, depends upon your findings are okay or your findings are giving you a way ahead. For example, client gives you certain information, and when you try to corroborate that information from some other factors or materials, you don't find the comparison one to one. Then you might go for further detailing investigation. And in some cases, the client tallies with your due diligence, which is okay, right? You can proceed. 102 also talks about the records, friends. Because it is a global standard, it cannot give a fixed record time period because in every country the laws are different. In India, it may call for 4 years, for 8 years. In other country, it may call for 10 years or 2 years, whatever. But it had mentioned that the importance of record keeping is important, and hence it may be varied depending upon a local statutory and legal requirements. So investigation is compulsory, friends, in every assignment. Don't write in your report that I have adopted the financials as given to me by the management. You will be absolving your sole responsibility if you do so. You have to backtest the data. You have to check it. You have to investigate to the extent you are convinced. All those data points given by the management. And also, friends, I have seen in many reports, people adopt as it is a market data without understanding the applicability of the data needs adjustments to your subject company. So you should not just adopt the data like it as it is. You should try to adjust it for your subject company, friends. So 101 and 103, friends, again they are part of report making, and if you combine all these two, your entire report is complete. Okay, the most important standards of value, which is called basis of value. Friends, again, IBS being a global standard applicable in most of the countries worldwide, so it will give you many standards of value because different countries have different standards of value. So if you see the round here, it talks about various values: market value, market rent, equitable value, liquidation value, investment value, synergetic value, and many other values. But it talks about, if you see in the bottom of the presentation, fair value under IFRS, fair market value under OECD and US IRS, and fair value under any local legal bodies. For example, you are appointed valuer under IBC, let's suppose. Then your duty is to give fair and liquidation value, right? So your basis of value will automatically become fair value because you can adopt fair value if it is defined by the local legal bodies. It is stated in the report, in the standard, right? And hence, the regulation also defines fair and liquidation value, which will come later and discuss. So let us discuss these standards of value and because of which the valuation changes. For example, friends, I am a stressed asset fund whose objective is to buy out the stressed funds, opportunistic funds, and sell it to the other clients at large. So if I am bidding for such a stressed asset, so my standard of value should be investment value, which means I will look at my holding period, I will look at my cost of funds for the subject asset, stressed asset, and will benchmark that and derive the value, right? In that case, my fair value, my standards of value would not be fair value. My standards of value would be investment value, right? If I am a investor and my typical cost is my cost of debt and my holding period of that asset. So if I know if I need to hold this asset for less than a year and my cost of debt is this, then I may sell it to some other companies, client. So those kind of standards are called investment values. Now there are companies. So for example, Jindal has quoted for Bhushan Steel, for example, right? So being in a similar industry, it calls for a synergetic value. So Jindal might be in different type of trades and Bhushan might be in different type of trades. So if Jindal is giving a value from outside, it would be more of a synergetic value. That what if I acquire, you know, Bhushan's assets in those locations or those verticals, it will add to my vertical and the summation would be quite higher, right? So I will become one of the largest monopolistic company in India. So all those value propositions are synergetic value without those orientations. That there are a lot of match, forward and backward integration, geographical diversifications, and all those things, right? Market value is friends that generally it's a assumption that under perfect conditions there would be a willing buyer, willing seller, transaction would be at arm's length, without any compulsion, with all the market information, you know. So all those purely perfect market assumptions defined under market value for any underlying asset. And market rent is again a market value only, but for a subject property, which is either rented out or ready to be rented out, or more of a land and building valuers. Equitable value is friends is generally value exchange between the two parties close ended. For example, there is an ABC private limited company. The two directors are separating and they have decided the value mutually between the two of them. That okay, you will give me for 40 rupees or 80 rupees, that is fine, and I'll take an exit. That value may or may not be the actual overall value of the company, but again, that is a equitable value between the two parties being coming to a negotiated price for some specified purposes and not for the overall value derivation of the company. So these are some of the standards of value which are defined and discussed here. And these are generally discussed with the assumed transaction and assumed party and assumed date. Okay, I have already given the brief description of the different values, but this is how they are defined. And friends, if you remember these definitions point to point, you will never forget these definitions, as I mentioned here. So, market value is estimated amount for which an asset or liability should be exchanged on a valuation date between a willing buyer and willing seller in an arm's length transaction after proper marketing, where the parties had acted knowledgeably, prudently, and without compulsion. And generally, friends, this market value is reflects the highest value of the asset because it talks about the uh, probable buyer or probable seller, right? It does not talk about the actual buyer and seller. And you will find, friends, most of the definitions are derived around these pointers only, not much of a difference, right? So must remember the definitions, friends, from the examination standpoint, and that is why I have given you on a very point-based system here. Now you see, the market value definition changes into market rent. It is all the same, but rent is pertaining to the property, rented out property, right? So it says estimated amount for which an interest in the real estate property should be leased on the valuation date between a willing seller and willing lessee, appropriate lease terms, arm's length transaction, proper marketing, acted knowledgeably, prudently, and without compulsion. Very similar to market value. This is what I was telling you that equitable value is an estimated price of transfer of asset liability between identified, knowledgeable, and willing parties. That means the two close parties are already there, actual parties, right? And they negotiate mutually the terms between themselves, which may or may not be the fair valuation of the overall company as on that date. Investment value also, friends, we have discussed wherever these are required for investment purposes. They want to buy, hold, and sell the property, and hence the valuation parameters would be entirely different than other bases of value. Synergetic value also we have discussed is a result of combination of two or more assets or interest where the combined value is more than the sum of separate two parts, right? And it gives you a larger synergies of values and economies of scale and other things for the overall valuation. Okay, this slide is very critical, friends, but it asks for premise of value, which means uh, whenever a company is going concern, right, either it will give you a current or existing usage or its best possible usage. And when a company is not in going concern, it is in liquidation. It will give you a either an orderly liquidation or a forced sale. So, for example, under IBC, it talks about if you go through liquidation process, it talks about orderly liquidation. It never talks about the forced sale. But when in liquidation and not going concern, you need to do the premise of value as orderly liquidation. You need to mention all these things in the report because these are forming part and parcel of your value derivation. And then reader should understand what basis of value you have adopted, what premise of value you have used to arrive your conclusion of value. Because with every small change, the output will change. Under going concern, friends, a plant or a factory would obviously will look at maximizing the resources being available there to create a larger wealth for any stakeholder. So you will always look at current and existing usage of that factory and see from a maximization perspective. So, for example, if there is a factory, friends, on a there is a rice mill on a national highway, right? And you go for evaluation and for a going concern. So you will be doing evaluation for that factory as a whole because as a rice factory, the idea is to generate the excessive cash flows from the underlying productive assets of the company, right? But the idea is not that because that land has now touched upon a national highway, the land value has gone so much up. So why not you as a valuer has derived the value of alternative usage of the land, which means can the land be used for a restaurant, a bar, a school, a college, hotel, hospital, integrated township, blah 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 blah. Because if a company is under CIRP, it is under resolution. The process calls for the current and the existing use. It doesn't call for a maximum usage. So one has to be very careful while choosing the premise of values here, friends. Okay, your favorite topic. IVS 105 talks about valuation approaches. Although, friends, we might have seen these approaches in our past, somewhere or the other, but these are the standard, globally accepted best practices that needs to be followed every time, every valuation exercise that you do, doesn't matter for what asset, be it tangible, intangible, financial, you need to follow all the three approaches. So typically, market approach talks about the instances of the transaction between the similar companies in the market, which means how a market is looking at your subject companies, competitors in the market between the buying and selling proposition. For example, if you're valuing a hotel, then enterprise value per room basis, how the market is transacting. If you are valuing a certain power plant, then enterprise value per megawatt of value. Suppose you're valuing something else, so those value drivers have to be seen from those parameters and how it is affecting your subject company. When you reach to cost approach, friends, the cost replacement cost of that standing asset today. For example, as an investor, you need to you know redo the entire asset today. What it takes to build a similar facility today, right? You acquire the land, you put the plant and machinery and all the stuff, and so what does it take to do so today? And there's a cost to it, and hence the income approach, which means from such productive assets, if they function, what is the excessive cash flow that is required to be generated, and you do the summation of the excess future cash flows to the firm, and you bring that value in today's valuation dates timeline for yourself, and that is how you conclude the value. Friends, you may adopt all the three approaches or any two of them, subject to the condition, facts, and circumstances of the case. But when you conclude, make sure that these values uh, are applicable. These approaches you can apply, and under these approaches, various methodologies you can apply. And before concluding, just see that there should not be, quite divergent numbers coming out of these approaches, because then you need to recalculate, iterate, go back, test your assumptions, because something from market approach cannot be very different from something from the income approach or from a replacement cost basis, because the science is same, right? You cannot have different derivation of values from all the approaches, which are very divergent. For example, you can't come out with the replacement cost of 50 rupees for the same asset and say my income approach is 100 rupees and my market approach is 100 rupees. It cannot be like that. It
Actually,
can be
sir,
100, 120.
hello,
Yeah.
sir. Do you have example of these three?
Example of
These three: market approach, system approach, and cost approach. Any example? Are
example
you
of what, sir?
valuation?
Okay. So I was describing that only. For example, if there is a 10 megawatt plant, right? So if I need to adopt a cost approach, I need to see what it requires to acquire such and such land at the similar position, right? What it takes to build the infrastructure, land and building there. I have to see what it takes to bring the assets, the plant and machinery, boilers, generators there today. So I need to build that thing today. What will be my cost? For example, let's suppose by calculating everything, I get 80 crores. So 80 crore is my replacement cost of the asset of similar size, of similar location today, if I have to put that plant today around that site. So that
And
becomes
you
my
have
value.
for
Yeah,
and you have to be engaged this plant and machinery and building valuers on this also.
yeah,
Okay, and just income approach also.
yeah. So these standards are friends for all the asset classes.
But hello,
Yeah,
are you not giving any side of kind of consideration to the present status of the equipment that we are going to replace? Because if you always compare with the replacement cost, you are considering the market value of the equipment against the old machinery that you are going to perhaps sell. So, is these two prices are at par? Can be considered at par? Are
you're
you,
right.
yeah,
You're
are they
right. You're
going
right.
to value?
No, no, no.
Yeah.
You're right. I am calculating the replacement cost subject to the life also, right? So when I
Yeah,
say when I need to set a plant, similar plant, which means I need to buy today and also deduct the depreciation.
Depreciation.
For example, the
Okay.
plant is 10-year old. I have to take that cognizance into the picture, right?
No. Another last time you have mentioned that when you are going to engage two valuers, if there is a wide difference between two prices, we are
Yeah,
going to engage the third valuers. So, is there
yeah.
any sort of benchmark or number that the difference must not exceed beyond 30% or 10%, 20%? So, in
See,
what circumstance third value or engagement is coming into the picture?
okay. So, friends, there is not a benchmark defined. Otherwise, it would have defined in the regulation itself. The regulation talks about the significant difference. So
Okay.
that is why I mentioned and put the pressure there, because a lot of issues are there with that English significant difference. And
Okay.
in general market practice, people adopt 10 to 15% as the digestible difference in the professional judgment, keeping
So it
everything
becomes
same.
very, okay, it becomes very subjective and relative terms. No, what it becomes very significant to you may not be significant to me. So it depends very subjective matter to the valuers, to the IP resolution.
Very true. The IP has to take the call along with the COC. So whatever they feel, they have to take. At times,
Okay.
I have seen the COC taking a call that 15, 16% is also acceptable, and at times they are saying 10% is not acceptable. So, as I
But
said,
it
this is a
depends.
debatable issue.
Yeah, correct. It depends upon the total value. Say if a small company, 20% may not huge amount. Whereas in case of like the Bhushan Steel, even the 10% or 5% may involve huge difference because it is in
No, no,
thousand crores.
we are talking in percentage terms only. We are not talking
Okay,
in
percentage,
value terms.
total magnitude. Okay.
Yeah, yeah. So I will be coming to individual questions in detail, friends, after
Okay.
just completing my slide, and we will discuss to any length on valuation. Happy to.
Okay.
Yeah. So friends, with this slide, I have covered 101, 102, 103, 104, and 105. So if you go for reading in the valuation IBS handbook, they are quite descriptive and detailed. And I suggest that you should go through after this class. You'll understand the relativity. But remember this presentation because this is a bird's eye view. You'll never forget these pictures, these formats, these templates, before you, and which is very important from a overall retention purpose also, for your practical purpose also. Again, what kind of approach you are able to adopt, basis of value, the respective strengths and weaknesses of each approaches, and under each approach there are methods. So you need to see, appropriateness of their applicability, and then adopt the approaches and methodologies, and conclude your valuation accordingly. Okay, there are certain specific asset standards, friends, which I mentioned and I told you before also. Certain business interest is defined separately, intangibles are defined separately, P&M are defined separately, financial instruments as such are defined separately. So, friends, do remember the number in examinations. For example, they might ask IBS 400 stands for intangibles, business interest, real estate properties, or development properties. So, you need to remember by heart these numbers. At times, the examination question might ask these questions. But for detailed asset standards, again, you must refer IBS rule book, which is generally available online, the entire standard book, and it is also a part of, I think, your curriculum also, and that is how your curriculum has become double. Okay, for your practical sake, friends, if you go to the IBBI site, IBBI publishes a quarterly journal. So every quarter, the journal publishes a lot of data points. So I have put in some data points here for your quick understanding. So this data point talks about the CIRP's yielding resolutions, which means companies which have been admitted as insolvent companies under insult NCLT, they have gone through the entire process of resolution and finally being resoluted by the COC and approved by the NCLT. So for example, let's take few examples. Uh, Point number three, MBL Infrastructures Limited, listed company. The total claims admitted were 1400 crores. The liquidation value was around 270 crores, but the resolution has come up at 1600 crores. Amazingly different. Take another example, Bhushan Steel. 56,000 crore is the claims of the creditors. Valuation has come around 14,500, but actual resolution happened at 35,000 crores. Again, this will give you a perspective, friends, that how things are changing. Now, see point number 10, Orissa manganese and minerals. The claimants have submitted a claim of 5,300 crores. Valuation is only meager 300 crores, and the resolution has happened at 310 crores. Again, these are certain examples that might give you an overall perspective of details of claimants and overall valuation and overall realization by the financial writers. Just for your practical side. Oh, as I was telling you, this importance of valuation is when you are appointed as valuers. So you are being chased by RPs, committee of creditors, even liquidators, and the investors to understand the value proposition. So value is very central to the process, entire process of resolution. Here comes the definition now, as the regulation defines. Friends, we have gone through various standards of value already: market value, market rent, equitable, synergetic, investment. Now you see the derivation of fair value is derived from the market value only. The second half, estimated realizable value of the assets of the corporate debtor if they were to be exchanged on the insolvency commencement date. Now, rest is all adopted between willing buyer, willing seller, arm's length transaction after proper marketing, acted knowledgeably, prudently, and without compulsion. So, after going through various standards of value, you realize 60-70% is the same as given in the market value. Only the 20-25% is changed. But remember this definition by heart if you are doing an IBC assignment, because you will require this every now and then. For a going concern company, friends, which is running, the COC may also seek for enterprise valuation of the company. They wanted to know, what is the enterprise value overall, and to calculate so you require a lot of, insights on the business plan to run your income approach, and to see the cost of capital, the B plan, the synergies, and all, etc., etc. So make sure you do deep dive all those things if you are being contacted for such a specialist exercise. Liquidation value as defined by the regulation is again the estimated realizable value of the assets of the corporate debtor if the corporate debtor were to be liquidated on the insolvency commencement date. Very simple. You as a professional has to think that when the company has entered into NCLT, that is called as insolvency commencement date, on that day, what is your valuation opinion on fair value and on liquidation value? Now, friends, understand you are being appointed after RP gets appointed, and RP gets appointed, then you get appointed, and after that you get information, and you may or may not visit the site. So by the time you do the calculation, already 60-90 days have expired from the insolvency commencement date. So you need to factor in very closely things which might have changed during that period of your appointment and your assessment and the date. It is very critical. So friends, if company goes into liquidation, henceforth it is not resoluted under a CRP process and the COC approves liquidation, then it enters into the liquidation regulations. Now the liquidation regulation requires the asset either to be valued as going concern as is, for which you have already done the value, or required as a sale of a group of assets on a piecemeal basis or on a single asset basis. Asset to asset basis, right? I can sell off the land separately. I can set off the DG set separately. I can set off the boiler separately, and likewise, right? So you have to see the scope of work very clearly, whether you have to calculate the valuation of the assets piecemeal basis, or you have to calculate the valuation on the going concern overall basis under liquidation regulation. And liquidation regulation talks about an orderly sale. Remember, we discussed orderly liquidation under premise of value. So regulation talks about orderly sale. And the kind of, I will like to brush through the planning process, the entire process of business valuation for you. So whenever you get a mandate, you need to understand the purpose, the critical data that you have to collect, the asset class under which you are appointed. You may have to do normalization of data, which means the client has given you some data input. You need to normalize it because that is your professional due diligence. You just can't adopt the input from the client. Then you may also see what kind of method should be applied under the subject company for subject purposes under each approach. Then you may or may not inspect. Being a technical valuer of land building plant machinery, you need to inspect. Otherwise, you may refrain. But anyhow, if you are a financial valuer also, and if you like to inspect, I would prefer that you should inspect. That will give you a lot of value drivers out of these companies for going concern. And then you may run various business valuation methods and modeling, certain limitations that you might have faced, overviews, reviews, and reporting, and complete your valuation process in entirety. Okay, I have given you a sample checklist that needs to be given to the RP when you are being appointed as a valuer under all the three asset classes. So first is fixed asset register for P&M guys. Second is for land and building, and then comes for the financial experts like you, like existence of any intangibles, details of any non-current investments, details of invoices of debtors, their bank statements from last 1 or 2 years, balance information on yearly basis, list of other short-term, long-term loans and advances, agreements, details of any advances being given to related parties, any disputed advances, and all those things that you may need to ask these client from the balance sheet perspective. And if you are doing a non-IBC case for a going concern, you may ask for listed competitors, unlisted competitors, projections, detailed projections with cash flow, balance sheet, and P&L, company's profile, detailed expertise of the promoters and founders, key USPs, and all those things, right? To understand the business, assess it, and deliver it. So, friends, if you are doing valuation from startup to insolvent companies, the challenges may vary from for a startup company, for a already growing SME, a large Fortune 500 company, or a insolvent company. So you have to think thematically about the purpose of your valuation, the stage where the company is, and proceed accordingly because it is very, very important how you deal with it. Okay, I have quickly sorted it out because I wanted to take your individual questions personally in valuations. Anything about valuations, you can ask me. Practical,
The
practical.
the
Yeah,
value assessed by the RV, is it indicative or is it kind of mandatory? That means if the parties are willing to settle at a different value than what is presented by RV, can they ignore the RV's report?
you're right. These are indicative opinions of value. As I said, now, very good point. You, if you are as an appointed as an RV under CRP regulations, you need to follow the regulations, right? Fair value, liquidation value, standards, all those things. But let's suppose I am a buyer of that asset. I may use the standard of value as investment value, synergetic value, or another value, which means my output number might be different from yours. So I will take decision of buy from my side. So yes, the value opinion from an RV is an indicative value for the entire COC to counter the price being paid by the respective investors. So let's suppose the COC has frozen 5 investors as per their filtration criteria, and you are only getting 5 investors which has fulfilled your criteria, and those 5 guys have given different valuations to your underlying asset, which means they can still give different value propositions depending upon their background. This does not mean that either your value is wrong or theirs are wrong, but a lot of assumptions underlying the reports are different. So COC takes, with respect to your indicative value, a judgment on that investor, whether to take those investors' plan or not, right? So we becomes an internal benchmark. That's an indicative value. But a COC can decide on a higher value, but obviously, and even a lower value. There has been a recent cases in last 6 months that they can still decide.
So can we give a range of values, say from X rupees to Y rupees, or it has to be a precise number like this much is the only value?
Again, a very good question. Uh, for a lot of transactional purposes, friends, you might give a range of value. For example, if I come to you that I want to sell my company's vertical or the entire company, then you may assess through various approaches and come to a conclusion that, sir, I believe that your fair estimate of valuation should fall between 100 to 125 crores, something like that. So you can still give that range, but the range should be reasonable. You can't give such. Your valuation opening can be between 100 crores to 200 crores. You can't give that, right? It has to fall within a reasonable estimate of range. Yes, you can give that.
The liquidation value, what you showed in the data from CIRP, that's the summation of all the asset class valuations?
Yes. See, for each asset class, land and building, plant and machinery, and SFA, everybody has to calculate these two values, fair value and liquidation value,
Mm-hmm.
for the RP to take a call. And RP will do the average of these two values for each asset class. And even nowadays, they are doing average of within the asset class. For example, a company is having 5 hotels, 5 locations. RP is still looking at hotel-wise comparison, which is right also, right?
Mm.
The difference should be only the professional judgment. It should not be the approaches. If I am following income approach and you are following market approach, the output will be different. That has to be seen.
Hello. Yeah, please describe this value income approach and tell me about this. There is a market approach and this cost approach and this income approach. So when we are
Yeah.
going to valuation for industry, so based on its going
Yeah.
concern or the liquidation and the merger and acquisition, so we have to take based on our approach, which will be the better approach to value this industry or a company.
Okay. So friends, whatever you do, whether the requirement, if it is not there in the regulation. So for example, in income tax, if you go, it has to be done through a certain parameter. So for example, if you are doing a valuation for certain assets, for certain purposes, as per standards, you have to test all the 3 approaches. You have to apply all the 3 approaches if they are applicable. For example, I'll give you an example. There is a company which is IT company, for example, right? IT's company. You go there and we try to test all the 3 verticals. You see, you can apply market approach. You see, you can apply income approach. But in cost approach, there is a challenge because you cannot capitalize your own intangible assets created internally unless it is bought. So you may state that there is a limitation in application of my cost approach in the present company because of these reasons, right? And hence I am applying market approach and income approach for my valuation exercise, and under each approach I am applying these standards. You have to test all the 3 approaches in every assignment and state the limitation.
Let's elaborate income approach, sir.
I'm saying you have to apply all the 3 approaches: income, market, and cost approach.
Actually, I have asked about the income approach. Suppose that you are just come out a particular year, that is the income is at 10 lakh, and how you will take the years, in how many years you will take about these things.
See, again, industry best practices is you cannot foresee after a level. For example, if your company is 5 years old or 10 years old, you can see how the company has performed vis-a-vis the market in last 8-10 years. That gives you enough precedence, so to speak, right, in the past. And giving that, the client has given you certain projections for 2 years, 3 years. But idealistically, we take at least 5 years projections because they are reasonable. Because beyond that, it becomes probabilistic, which means I am just taking any number after that. It is not certain. Only 1 and 2 years are certain, and after that, it becomes probable because you have to do a discounted cash flow approach on a two-stage model, which is a variable state and a steady state. So you have to discount at least 5, 6, 7 years before it goes into the steady state. Your company might be in a growing phase, and in a growing phase, you cannot go steady state. You have to grow a bit and then go steady state. So at least 5 to 7 years, you have to take a variable state and then take the terminal value. I hope I answered your question. Any other question, friends? Yeah.
Hello. This income method can be applied for the valuation of plant and equipment, or it is for the business only, business as a whole?
See, again, plant and machinery is a productive asset, right? And if you're adopting income approach under plant and machinery, then somewhere or the other you are ending up with the enterprise valuation only. Because if the entire business is of that plant and machinery, I'm saying if you are driving the cash flow generated by those plant and machinery, it will tend amount to enterprise valuation only. Overall valuation of the company.
Okay. So this income method is appropriate for what kind of valuation?
As a financial valuer, you have to test all these approaches under any method, under any circumstances, for any purposes, either regulatory, either transactional, or accounting. Yeah.
Okay. So there is no kind of rule or principle that this method is more appropriate for valuation of this kind of method and this method, so that it becomes handy for a valuer.
Generally, I'm telling you, in general business valuations that you might face after becoming a super expert, client will give you projections,
okay,
right? And and you have to adopt market approach. So most of the times you will be ending up with market approach and income approach mostly.
Sir, for early stage companies, when we are doing discounted cash flow, what is the procedure followed for having a terminal value?
Procedure followed for?
Terminal value, determining the terminal value in general.
See, there are standard models. I think if that class is not being done, your class is due for all methods and approaches in detail. So I'm not going down into each approaches. So there is a standard model. For example, to calculate the cost of equity, you go for a Kappa model. To calculate the terminal value, you go for a Gordon growth model, right? So all are there. Standard methodologies are there. And there are enough, descriptive case studies also available in the market. So in the past, groups have been added. There are a lot of books and knowledge things are there. So I'll keep sharing with you guys also, whatever is there.
Can we use of approaches in one valuation? Kind of different.
Yes. While you're doing conclusion, you will be taking the inputs from all the approaches. Why not? That is how you conclude, right? And also, I must tell you, the old school of things. Like I have done calculation from 3 approaches: cost, income, and market, and we used to just average it. Please avoid it. This is not a global best practice. Which means you are doing cost approach 50 crores, you are doing income approach 100 crores, you are doing market approach 150 crores. And if you're just doing simple average, what will you get? 100. Which means all the 3 approaches have gone for a toss. So you as a super expert have to go back and test what method under each approach is eligible in particular circumstances of the situation and the purpose for which it is valued. It takes a lot of time, friends. Even after doing all those things, you come to conclusion and you have to go back and come back, go back and come back. A lot of iterations are there. You may get different outputs.
Sir, is there any validity for the valuation report?
Isn't there any?
Validity, time validity or something?
That depends upon the regulation, but generally for a financial reporting, they generally take up to 6 months.
For examination point of view, that your presentation is sufficient, or we have to be just go for other ratings and other IAVS standards from the website or
Sir,
valuers.
if you will, as I'm telling you, IVS is part of your curriculum. It's a more than 200-page document, and if you start reading, I don't know whether you will be able to end it or not. But with my experience and little bit knowledge, I have tried to give you the best of gist of the entire standard, both from a practical standpoint and from a theoretical standpoint. If you will go by 5 slides in 5 minutes, your standards are by heart. If you understand the spirit of valuation, but I will suggest go through the write-ups once in the standards to connect and correlate to the output. At times when you get a gist, you don't realize. When you read the entire story and then you compare with the gist, you will never forget the gist. It happens because I am the story writer. I remember it by heart. But for you to go through it, you should also go through the story first and compare with the gist.
You are
Summary.
also registered value, sir?
Yes. So from practical standpoint, these standards are very important. These definitions are very important. For any query from any person, you will defend with these definitions only. These are your tools. We use these definitions very now and then. I will share with you in the group the practice textbooks which you can go through. The best part is you do the classes and same day you go through the practice textbooks. Otherwise, we all are professional friends and we have our own responsibilities. So we tend to go off the track. And the best time is, you invest 18 hours a day, but today, because everything is in your mind. If you say that I'll study at the end after 2 weeks, after a month, it will not happen. You will lose the momentum. Because number one, we are all married, mostly. And number two, we are all in 10, 20 years of already experienced profession. So we have families, we have work to handle. So it is very difficult for us to, focus time for studies. So we'll share with you the questionnaires, the MCQs for you to go through. And I hope your classes have just started. I think we are on the early side of the start classes. It will go
Yeah,
ahead.
it is 3 days.
Finished?
Maybe it's 3 days.
Acha. Okay. So you will learn a lot of things in the entire process. The law portion, the financial portion, the regulation side, and take due note of the weightages as case studies and specific examples, and practice as much as possible, because most of the things practical side you might be aware of, you might be doing it yourself, but practice as much MCQs as far as possible, friends, because that will give you a hands-on. There are online test paper available on the IB-based site, institute site. Go through it. 90 minute, 120 minutes. and see your score where you come.
Mr. Gagan, may I suggest you one thing? Since we have time in hand, if you have some MCQ, can we run through it? It will give a
Sir, I
fair
am having.
idea.
I said from the standard perspective, the MCQs are generally of 3-4 kinds. They will ask the standard name and number either ways, and with different options. They'll ask the asset specific standards or general standards. From a standard perspective, they can
I think
ask you
you
for.
have developed some MCQs, on this
I,
chapter.
I will share with the entire book, sir. There is no need to
Okay.
develop.
No.
I'll
Okay.
share with the entire book of 200 pages. You do that.
What I was suggesting, since we have some time, can we run through this right now and see what are the MCQs, that probable MCQs that may come into the examination?
Let me see.
Oh, thank you.
Okay, I have already added here. Wow.
Yeah, you have something. You can go through it right now. Because as you have rightly told, we are all family man. We may not have enough time to subsequently go through. So let us just have an idea right now.
If everybody is on the WhatsApp, here comes the book.
You have sent on WhatsApp.
The entire book. Wait, it is not. I think it's. No, wait, it's not going. I think my net is weak. It is quite heavy. 440 pager. I'm trying to send. Yeah, go on. Have you got it?
Let me check. Yeah.
Yes, sir. Yes.
Yes,
Yeah.
you received it.
Valuation.
Now it has got various sections to it. So chapter 14 is overview of valuation. (15-pager) MCQs. You can download on your desktop, and it is far easier for you guys to see. Phone is a little painful for such a detailed. And I will suggest surely that you should practice these MCQs after every class.
Sir, is this the book, the latest book?
There, it has got various editions, Harmeet.
All right.
But I think any edition is good to give you a heads up on the overall MCQs. There could be minor changes here and there, but mostly these are all practice sets.
Okay. So, when this book is sufficient if we go for this one.
See, I think with your background knowledge and expertise, I think you need some kind of practice MCQs, and these have got enough. But wherever I have got much more material, I will just from other classrooms will share that also.
Sure. Thank you.
There is no dearth of data. You were asking the edition. I've got the second edition also. Oh, it's quite heavy. But I have pasted it. It will come in. I think you all are on the WhatsApp group. I have shared the one edition of book, and the second edition is going up only. Anilji, I'm sharing on the WhatsApp.
Okay. Thank you very much.
Pleasure, ji. Is anyone from your side has already have done any valuations before for any purpose with anybody? Now you must have got the second edition also.
Yes, yes, received.
Open in your desktop and download it because it is easier for you to go through in the desktop than in phone. So nobody has done any valuations before for any purposes?
I have done for some startup
professionals?
companies, but I did it with some colleagues.
Startup companies, that's an interesting space. So what is
Can you
special about
please
the startup
speak,
valuations? Entire people here? What challenges you faced?
So basically, they do not generate any income, and there is no such say uh, plant and machinery or any assets as such. So only thing they have is their team and IPs.
All IPs are here.
Right. So how would you typically generate value for that?
So what approaches you have adopted?
So typically, we run through their cash flow and other calculations.
Cash flow.
Presentation. Cash flow in the sense cash flow and their it was a IT company per se. They were earning some money, but they had more kind of startup digital marketing and all the things.
So you did from only income approach?
Income as well as market value approach.
How did you use market value?
They were given. They had given us some typical companies in that particular area and their merger acquisition ratios. So at what value they are trading or what value they are doing this mergers and takeovers.
So have you back tested their income forecast?
I am not that sure what we did, but I just assisted my colleagues. Yes.
So don't act icing on the cake. You'll get caught.
Yeah.
You have to deep dive into the whenever you get a direct assignment, you need to backtest the financials, how they arrived, justification on the assumptions.
Right.
If you read the which I was telling you, use of caveats guideline in IBBI's website, 1st September, it clearly states that in the valuation report you need to state that you have reviewed the financial provided by the client. You have done certain things for your satisfaction. and there are caveats or limitations that one cannot use. You cannot use that I have adopted the financial projections given by the client. You can't write this in the report, which means the the onus is on us, and we are not absolved from our responsibilities and duties by saying so. Startups are tricky because they don't have the precedents, cash flows to justify their income approach. And the founders will happy to give you any kind of income approach. सर कैविएट्स का मतलब होता है वार्निंग, लिमिटेशन मतलब कि आपके स्कोप ऑफ वर्क में लिमिट कर रही हैं वो चीजें, और डिस्क्लेमर्स मतलब कि यू वांट टू लिमिट योर रिस्क एंड लायबिलिटी by the end user report, which means that you're not you're defining who can use your report. If your user of the report is getting incurring any liability, loss, damages, you are not being tagged along, and you are not be fulfilling that loss. You should warn the reader about any thing that you want him to warn about while going through the valuation you have faced, and also stating your limitation. And you ask for 10 things from the client, you have only got 4. So your report is subject to 4 inputs only, not the rest 6. And what assumptions you have taken in the hindsight to fulfill your obligations in the absence of those 6 pointers. Right? So